Hey guys, welcome back to the channel. I hope everyone is doing great. Today I want to go over this new Theta ETF from SoFi, THTA. Just based on my initial impressions, this looks like it's credit spread-based options ETF. And there's quite a bit of things to unpack here, so let's get going. So the yield max individual option ETFs, like they're not that diversified, at least not yet. Just based on the ones that are available now, most of them are, I guess I would say, based on like a single stock. That is until the YMAG and Y the other new YMAX ETF comes out, where it's kind of like the best of all worlds, where you have like for example the YMAG that's going to be based off of the so-called Magnificent Seven stocks, and then you have YMAX, which will be like kind of everything that YieldMax offers all in one package. But I guess in the meantime, THTA, this could be a kind of like a middle ground from SoFi. So let's dig into it some more. So similar to some of these other high yield ETF products, they're using treasuries as kind of like their backbone first, and then they're going to sell credit spreads based off of the major indices such as SPX, NDX, and the RUT. And the reason why I'm calling this maybe a credit spread or even like Iron Condor based ETF, I think this would probably like the first of its kind potentially. So this is pretty interesting. So I don't have any yet, but this is definitely on my watch list because it's still relatively new. So there's a few things that I want to see for myself firsthand. So this is good news in that it's also a monthly paying ETF. So that's one good thing. And then next, the expense ratio is pretty good. It's 49 basis points. Uh, just based on just reading like the perspectives and other things. So I was digging it into some more. So this is pretty interesting. Uh, so they have the usual U.S. Treasury bills and or U.S. Treasury bonds as collateral. And this is pretty interesting. Now they're saying that they're going to use this to sort of set up 90% of this uh, available capital to do credit spreads. And I guess I'll explain the credit spreads a little bit more in case like you're still new to options. So basically, a credit spread, you're selling one option that's out of the money, and then you're buying another one that's even further out of the money to give you some protection. And like in the prospectus, they go into it a little bit more. So this is really interesting because they're trying to set up positions where it's maybe like around 30 days out. And then if you read more into the prospectus, they're trying to sell it pretty far out of the money, 96 to 98% out of the money. So that they gives them that amount of probability of success. So, and then if you look through like the portfolio managers, if you notice, Mike Brokaw, Jay Prestricelli, Chow Dan, and Charles Ragaus. If these names look familiar, uh, if you said like, "Hey, wait a minute, aren't these like the same people like behind Yieldmax?" Yep, ding ding ding, you win a prize. So So let's go back to like the expense ratio. So you're basically getting the yield max managers at roughly like half the price of what you would normally pay to yield max, like at 99 basis points. So this is really interesting. Because again, as I mentioned, I think this is the first. There are other yield ETFs that give you exposure to credit spreads, or or actually I think some of them also offer like debit spreads as well. And then they kind of give you like a limited upside potential if you're doing a credit spread, and then you're getting like a slightly more return potential on a debit spread. But let's try to keep it simple for you guys. So basically, when you're selling out of the money credit spreads, you're hoping that it doesn't touch the short strike. So a credit spread is like you're selling an option, either a call or a put, and then you're adding another option on top of that to sort of like protect yourself. So your maximum risk is like the distance between the strikes, and then an iron condor is basically a call credit spread and then a put credit spread combined together. So maybe if we go through like an example, it might be more clear, especially for those of you that are relatively new to the options world. So let's look at the put side of like the credit spread. So as you can see, there's two screenshots from my Thinkorswim platform that's offered by Schwab. So on the put side, as you can, hopefully you guys can see this. So for example, like at the time of this recording, like the SPX is around 45.14. So you're selling the 4100 put, and then you're buying the 4050 put as protection. And the reason why I chose these strikes is because, like, just to go back to one of the slides here, because you're trying to do it 96% out of the money. So these particular strikes are roughly like the four delta, and that gives you roughly like the 96% out of the money chance of expiring worthless. So then for this particular put credit spread, you're getting about 80 cents, or and then like because like the multiplier is 100, so you're basically getting $80. And then the max loss on this position is the remember I told you that it's a difference between the strikes. So 4100 minus 4050 is 50, and then you multiply by 100 because that's the multiplier for like this index. And then the 5,000, you're subtracting out the 80, and that gives you the 4,920. That's like your max risk because your theoretical max risk is that 50 point difference. But remember, you're collecting $80, so that lowers your overall max loss to 4,920. And then that gives you, assuming that it expires out of the money, this gives you about a 1.6% a month. Again, like every month, like you do this, or attempting to do this, like you should be trying to get like around like this kind of like this ballpark figure. Some months might be better, and then some months might be less. But this is kind of like roughly what you can expect. And then also on the call side, on the bottom here, uh, let's just say like you're selling the 4800 call strike, and then you're buying the 4900 uh, call strike for protection. And the reason why this one is 100 points difference is because that's what was available on the platform at least at the time of this recording. Maybe over time, like if the market heads up, they'll open more strikes so that it's not just like the 3 delta and the 1 delta that you see over here. But anyway, what's important is that this gives you about $95, and then the max risk on this side, because there's a bigger width between like the 4800 and the 4900 strike. That's a 100 point difference, and then again you multiply by 100 because that's the multiplier for the SPX index, and that gives you a $10,000 risk minus like the $95 that you collect, and that your overall max loss potential is $9,905. So if you do like 95 over 9,905, that gives you potentially 1% a month. Again, this assumes that it expires out of the money, and because like it's so far of the money, most likely it'll expire worthless. But again, sometimes in a crazy market, you can still lose money, just so you know. But here's the interesting thing. Back over here, like there was a potential that if they're saying that it's far enough out of the money and it's a high probability event. So, but remember, you can't lose on both sides at the same time. So that gives you a potentially a way to collect 175 bucks on this 9,905 risk. And if they are selling iron condors, that could give you 2.6% a month, which is pretty good considering that you have like a limited upside, but then you have like a high risk ratio, but you have a to kind of offset that, you have a higher probability of success. So I think this is a very interesting strategy. So I guess like month to month though, based on like the fund manager's like discretion, um, they they could choose to sell maybe just like one side for the month. And this is just based on like my assumption. I don't know if they're actually going to try to sell it like exactly like 1 month at a time, or if maybe they'll spread it out and try to do maybe like a weekly here. So it really depends on how like the managers set up their positions, and we'll find out like more once they you know once we see like the first payout. So this is a very exciting strategy. Well, at least for people like me that are into like these high yield ETFs. So now the question is like when is the payout? So that's going to be determined. And I'll probably wind up making like a follow-up video to this. And and this is just like my rough estimate for now. I expect for this type of ETF to pay between 12 to 30%, depending on the volatility and how they set up the strikes, and of course like which index are they going to use, or maybe they might wind up using all three. So then there's a lot of like variables up in the air, but this is really interesting. So I would say like this is a pretty convenient way because I used to do these strategies on myself, but on a smaller scale. So it'll be really interesting to see how they do over time because this could really save me a lot of time and headache. At 49 basis points, I think that could be a potentially a really good value. So this is kind of like a value priced yield max fund in disguise. But then also the bad part is like since it is the same managers as Yieldmax, since I already have like for example Tesla, Coney, and I've traded NVDY in the past, I don't like having all this concentration uh, just on like these four people. As good as they might be, it's still kind of risky. Like hopefully they'll keep the team together for like a while. Um, and then of course like we don't as the usual risk of we don't have any control over like how they set up their option strategies, and then of course like implied volatility collapse, and the yields are not consistent month to month, and I hope like they're not the yield max team is they're not stretched too thin because they're managing a lot of different funds now, and hopefully we don't like it's a half price expense ratio, so I hope we don't have like half price returns. But I want to stay optimistic in that like maybe it's not really just like these four portfolio managers. Maybe they have like a bigger team, depending on like if they're working on like the yield max products or the Defiance ETF products, and now like the SOFI THTA product. Um, so I'm kind of hoping for the best. And I'm kind of watching to see how they set up the strikes. That's really interesting to me, and to see if they really are gonna set up a nine condor. I'll be really interested to see how they do this. So if you like this type of content, please consider giving this a like and subscribe. I think my subscribers are pretty cool people, so I hope you guys make a lot of money, and I'll see you in the next video. Bye now.